The market whispers uncertainties. It speaks of interest rate hikes and inflation worries. Headlines scream about tech corrections and recession fears, but beneath the surface of these anxieties lies a powerful truth. Times of market fear are often times of tremendous opportunity. Remember, every market dip is a chance to buy valuable assets at a discount. This isn't about gambling or timing the market. This is about understanding that market fluctuations are normal. They're part of the natural rhythm of the financial world. Savvy investors don't fear these dips, they embrace them. When others are fearful, that's when fortunes are made. But it takes courage, patience, and a little bit of know-how. Let's equip you with the knowledge you need to navigate the market of 2025 and beyond. 2025 has been a year of adjustments. The global economy is finding its footing. Interest rates are rising, making it more expensive to borrow money. Inflation, while cooling down, is still a concern for businesses and consumers alike. The tech sector, which soared in recent years, is experiencing a correction. This means that high valuations are being re-evaluated, leading to some pullbacks in stock prices. This might seem alarming, but it's a healthy part of the market cycle. Don't let the headlines fool you. The economy is still growing, albeit at a slower pace. Jobs are being created, and consumer spending remains resilient. This isn't a time to panic, it's a time to be strategic. Investing is as much about psychology as it is about numbers. When fear grips the market, investors tend to sell, often irrationally. This can create a snowball effect, pushing prices down further. But remember, every seller has a buyer, and those who buy when prices are low are often rewarded in the long run. This doesn't mean blindly buying everything in sight, it means taking a measured, informed approach. Warren Buffett famously said, "Be fearful when others are greedy and greedy when others are fearful." This simple yet profound statement encapsulates the essence of contrarian investing, finding opportunities where others see only risk. So, where are the opportunities in 2025? While the tech sector has taken a hit, this correction has created potential buying opportunities for long-term investors. Look for companies with solid fundamentals, strong balance sheets, and a track record of innovation. Other sectors like healthcare, infrastructure, and energy often get overlooked during tech booms. These sectors tend to be more resilient to economic downturns and can provide stability to your portfolio. Remember, diversification is key. Don't put all your eggs in one basket. Instead, spread your investments across different sectors and asset classes to mitigate risk. Section 5. Navigating the Market Roller Coaster Strategies for Success. Now that we've identified potential opportunities, let's talk about strategies. One effective approach is dollar cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of market conditions. Another strategy is value investing, championed by investors like Warren Buffett. This involves identifying undervalued companies with strong long-term potential. It requires patience and research, but can yield significant returns over time. Finally, consider sector rotation. This involves shifting your investments between different sectors based on their performance and economic cycles. For example, during periods of economic growth, cyclical sectors like consumer discretionary and industrials tend to outperform. Section 6. Following the leader's institutional money and retail trends. It's always wise to pay attention to where institutional investors are putting their money. Pension funds, hedge funds, and endowments manage vast sums of capital. Their moves can provide valuable insights into market sentiment. On the retail side, platforms like Robinhood have made investing more accessible than ever. While this has democratized finance, it's important to be aware of trends in retail investing, as they can sometimes contribute to market volatility. Keep an eye on ETF flows, which indicate the movement of money into and out of exchange-traded funds. These flows can reveal investor sentiment towards specific sectors or asset classes. Section 7. Your first steps to financial freedom. Beginner-friendly investing. You don't need to be a Wall Street wizard to start investing. Begin with low-cost index funds or ETFs that track broad market indices like the S&P 500. This provides instant diversification and exposure to a basket of leading companies. Consider dividend-paying stocks. These companies distribute a portion of their profits to shareholders, providing a steady stream of passive income. Look for companies with a history of consistent dividend payments and strong financial health. Emerging markets also offer compelling opportunities for growth. These economies are rapidly developing and can provide diversification benefits to your portfolio. However, they also come with higher risks, so it's essential to do your research. Section 8. The future is bright. Embracing the long game for lasting wealth. The market may seem daunting, but remember this: time is your greatest asset. Don't get caught up in the day-to-day fluctuations. Instead, focus on the long-term horizon. Start small if you have to. The most important step is to start. Educate yourself, stay informed, and don't be afraid to seek guidance from financial advisors. In the words of the ancient Chinese philosopher Lao Tzu, the journey of 1,000 miles begins with a single step. Take that step today. Embrace the long game of investing and watch your financial future unfold with confidence and clarity. Don't forget to comment, like, share, and subscribe to Money Mindset with Proud Mary for more financial tips.